welcome to the Saving with Steve show, where we talk about the ins and outs of money. Pretty much everything in the sun relates to you having a happier, healthier relationship with money. My name is Steve Sexton. Thank you for joining us. Thank you for sharing us with your friends and families. We're well over 1 million listeners and viewers, so we're very happy with that, and we appreciate you and wouldn't happen without you. But today, hey, Thanksgiving's just around the corner. Then we have Christmas. Many people are looking to buy gifts, food, travel, and it's stressful. That's why I have Brett Bernstein here to help us through the holiday spending, make it simple, how to budget, plan, most importantly, how to celebrate without stress. Brett, welcome to the show.
Thank you for having me. I appreciate you asking me to come here.
Yeah, for those of you who don't know Brett, he founded XML Financial Group. He's an active financial planner, certified financial planner. He assists clients with holistic approaches to goal setting. Prior to that, he was a senior vice president with Merrill Lynch. Brett is also a serial entrepreneur, actively investing in many startup companies. He's also a sought after speaker, industry commentator, has numerous contributions to Wall Street Journal, Financial Advisor Magazine, Investment News, and more, even Forbes in there. So with that, we're really happy that we have Brett here. So again, Brett, thanks for being here today. You've been doing financial planning for a long time. All our listeners and viewers like to know what got you into that.
Yeah, that's a great story. I actually was set to go pre-med, and my father, a retired physician, explained what managed care was all about. And when I learned about that, I said, I don't know if I like that. He said, well, if you want to help people, why don't you intern with my stockbroker? I started interning, and lo and behold, I swapped from pre-med to business. Here I am 27 years later and love what I do. I get to help people, but I don't deal with managed care.
That's great. You don't have to deal with blood every day.
That's a good point.
You know what? We got the holidays coming up here. Thanksgiving. We've already seen the catalogs for Christmas coming out for kids and all that stuff. They're trying to get everybody going early. People are trying to figure out how they're going to spend, what they're going to do. So let's just start talking about budgeting for the holidays. What's the big thing that everybody should be focusing on?
Yeah, you said it best. I feel like every year, early and earlier, I see the stores setting up or I see the magazines coming out. But I think the first thing is people have to really just look at their normal expenses between now and the end of the year. You have to make sure you have covered your normal expenses that you need day to day. And then you have to say, okay, is there a reasonable budget or are there specific things or experiences that I want my friends and family to have? Sometimes people set a number and that's it. And sometimes people set the experiences and back into the budget. Each person's situation is different, but both approaches can be beneficial depending on your situation.
So when you're talking about experiences, you probably worked with a number of people. What type of experience would people like travel, family get-togethers?
For my birthday, my dad just got me something. He and I are going to go drive a tank and you get to smush cars. So it could be an experience from a trip, right? A trip. It could be going to a spa, cooking classes, driving tanks and smushing cars. You'd be amazed at stuff that I hear people do. Some don't surprise me. Some I'm like, hey, if that's your thing, God bless you. Enjoy it.
I was just at Dream Racing in Las Vegas where they bring out the Ferraris, the
Oh, wow.
Lamborghinis, the Porsches, and they have a coach, a professional race car driver drive with you and teach you how to do it. It's very cool, especially when you get to 175 miles down the straight.
Yeah, make you clench a little bit.
Actually, it's fun.
I love it.
So here we go. We're looking at gifting, entertaining, travel. What are the things that people need to start looking at with those?
Yeah, there's different things that you have to think about. One, are there coupons or opportunities? For example, when you're booking flights, you have to look at certain days of the week or times where you might get a better flight. With the government shutdown right now, especially with air travel, that's a little up in the air. Hopefully that nudges us over the finish line to get some agreement and opening here. You have to look at opportunities to take advantage of something. A lot of times airlines will say, hey, we're offering you the ability to buy up miles at a discount. And those are the type of things I just delete them. But now you have to start thinking, maybe I should. So if I am going to look at taking a trip or I'm going to offer a trip, even if it's a holiday gift and we're going to do it in the new year, why not look at buying a discount? Restaurants do it all the time. Spend $100, get a $25 gift card for free. Airlines and other things do that as well. And I think people just need to pay attention. I'm not one for playing the credit card game or racking up debt, but a lot of credit cards do offer opportunities. Sometimes people open a specific credit card because they're given hotel stays or airline miles. I'm not saying to do it to carry debt, there could be a strategy where maybe I get rid of my ABC Visa card and I get my DEF card because it allows me to get 5 hotel nights, which can be the difference of someone taking a family trip or not.
I did that one. We got over 100,000 points by putting regular expenses on a credit card. Basically, you went to Hawaii for free. Yeah.
People just need to spend a little bit of time. Look, what I do is planning, right? I think ahead. So if people would do the same thing, not just in their overall financial situation, but a trip, gifting, experiences, you can find really interesting opportunities out there. And if you're willing to be a little flexible sometimes on when you do things, the difference of 1 week of when you travel could be 50% cheaper. So
Oh,
also
yeah.
having a little flexibility could be of interest as well.
That's good to know. So here's the next thing. With all this going on, what's the best way to stay on track?
I think it's like anything in life, setting a plan, right? Have a plan, monitor it, and then, of course, be nimble if you need to make changes. But a lot of times people don't, right? So if you're planning a big trip, you decide in January, I want to do this trip for Christmas break. What's it going to cost? How much do I need to save per month? Or let's say you're paid twice a month. If I can take X out of each paycheck and I move it into my money market account, my money market's giving me 3 to 4%, then by the time the trip comes, I should have it paid for. And maybe you won't really notice it as much, but that's not how most people operate, right? Most people, it's either last minute or I want to do this trip. And then the next thing you know, how do I pay for it? They put it on a credit card, they rack up the debt. And before you know it, they're paying 21% interest, and that trip becomes the most expensive thing they've ever done. So really plan early, monitor it, and be nimble along the way.
Hey, folks, stick with us. We're going to be right back with more Brett and Saving with Steve. Hey, welcome back to the Saving with Steve show, where we talk about the ins and outs of money. I truly want to thank you for tuning in. I appreciate you letting your friends, family, and associates know about the show. All the replays are available. If you're enjoying the stories of helpful insight on Saving with Steve, I encourage you to subscribe to our YouTube channel. Never miss a show. Check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York. They're dedicated to empowering you to uplift your life and spirit to live a life of personal and financial freedom. So let's get back to Brett Bernstein. And let's talk a little bit about holiday debt. Everybody, they look at, hey, how do I get through buying these gifts? How do I get through doing the travel? How do we work on avoiding those things to make sure we don't have that big hangover come January 15th when we get our first bill?
Yeah, I think the first thing, like we've talked about, is planning and saving ahead. Right. The second thing is, are there things you can cut out? Everything's a give and take. Do I need the Starbucks coffee for $7 a day when I can make coffee at home? But saving the delta between the Starbucks and my homemade coffee might be the difference of me actually building a significant gift for my family and friends, right? Sometimes we have to make sacrifices. Another way is when people get, if they're in a job that they get bonuses, right? A traditional salary and bonus job. I think that you should always save some of your bonus. Some of it has to go to taxes, and you should enjoy some of it, right? So I think, again, if you're in a bonus structure, if you're in a commission structure, making sure you're putting the money away for taxes, but putting a little bit away for the things that you might want to be able to do. So that is all planning ahead. But sometimes people are in a predicament where they can't, and I can appreciate that. So you have to try to, what debt can you take on that's manageable? Not paying ungodly rates on credit cards. So are there opportunities if you did have to build up some credit card debt that you can move it to another credit card that's either at zero interest or a lower interest, or things like that can help. I'm not a fan of borrowing. People sometimes can borrow against their 401k. So if you do have to borrow money, at least you are forced to pay yourself back, right? Because you have to pay back your 401k with interest. So at least you're paying yourself the interest back. I'm not a fan of taking on home equity debt. If you know you have to take on debt, plan for it and be strategic in the way that you do it. You don't want it to become a snowball rolling down the hill that just gets bigger and bigger, and you're in a tough spot that you can't unwind it.
I agree with that. You don't want to start taking on debt, especially if you haven't learned how to deal with that debt. Now, let's also talk about what we're coming towards year end. Everybody's trying to figure out, hey, what do I do? We got taxes. Another, was it 40, about 6 weeks or so, and the tax year is over. So how do we put things in place right now? And with all this uncertainty that's going on, we got the government shutdown. You know what? Let's talk a little bit about investments to consider before the end of the year.
Yeah, I mean, I think a couple things for retirement plans like a 401k that must be funded with the employee contribution by 12/31. So If there's savings you want to be doing in those types of plans, you have a deadline. Now, other types of savings, Roth IRAs, SEPs, IRAs, those go to the tax year, right? So you have until your tax filing. So I think thinking ahead on some of those savings. Second thing is, while the market's down a little today and was yesterday, in the scheme of things, most people in taxable accounts are probably in positive territory. So currently, there isn't a lot of tax loss harvesting that people can do. That doesn't mean that's not going to happen with volatility. If you think back to this year when Liberation Day happened, and this is not meant to be a political comment at all, but the markets took a big dip, right? Good advisors, do-it-yourselfers, should have taken advantage of selling at the dip, locking in losses, because you're going to need those losses to offset future gains or distributions from mutual funds. Being active and mindful is important. But with all the gains that are out there, I do think a lot of people might be in a position that they punt until next year. So you could see some pressured selling in January when people raise the cash they need, credit card bills, taxes that might be due if you have quarterly estimates. So there could be some selling in January because then they can pump those taxes for another year. I don't know if there's a lot to do in the last 6, 7 weeks if the markets stay high, but if we get some negative pressure on them, there could be opportunities to look at tax loss harvesting.
Okay, so let's talk about the investment side of things. There's so many people that just sit at their jobs and they're like, I'm retiring December 31st. I'm
Right.
done.
I'm done.
If somebody's thinking that way, and I know we've got 6 weeks before the end of the year, how should they be planning for something like that? I know you're a planner, this is what you
Yep.
do, and they probably should have been planning like six
Yep.
months ago or a
Yep.
year ago. But hey, you're going to retire in 6 weeks, or you just found out now that the company's going to say, hey, we're giving you a buyout,
Right.
or hey, we're going to be laying off people and it's going to happen in January. So, what are the things you need to take a look at right now? How do you get prepared for something like that? And the reality is, who should they be talking to? And obviously, it's somebody like yourself, but
Right.
let's talk about that because that's really important.
That starts with someone like me, right? A wealth advisor that knows what they're doing. You need to talk to the benefits people at the company. Make sure that you have maximized any pre-tax savings, right? Whether it's an HSA account or 401k, make sure you're not leaving any of that on the table. You want to understand if you have any unused PTO. Are they going to pay you out on that? Is it use it or lose it? Or are you going to take it and just coast into the rest of the year? You don't want to leave benefits on the table. You want to understand, very importantly, your health options. And obviously, it depends what age you are. If you're of Medicare age, you want to understand what health options there are. Are there continuations of it? Are you going to be on Cobra? Do you have to go onto the exchange? Getting with a benefits person, HR for the company, they're usually going to be able to walk you through step by step. And then you have additional things like, was I waiting to file for Social Security? Are you at that age? And so are you going to file for Social Security? It's a combination of the company's HR/benefits people and your wealth advisor, because both of those people have no emotion. They're giving you factual things that you need to make sure you do for your situation and remove the emotion of, wow, I've been with this company for 30 years, or I can't believe they're laying me off or giving me a buyout. You need people on your team that can remove that emotion and make sure you're making sound decisions with the advice that you have.
I agree because the reality is most companies, they're making an unemotional decision to lay somebody off or to reduce staff or to do a buyout. And you should be operating the same way for your future. But now that we've got that, what should people be doing if all of a sudden, hey, I'm getting laid off and I think I might be able to retire? How do I figure out if I can?
So the first thing is, I'm a big believer in doing a financial plan. You want to know, what do you own? What do you owe? Where are you today? Where are you trying to get to? You quickly need to load in, what can we afford to do, right? Because the planning is really going to give you the opportunity to understand, can I afford to fully retire? Do I need to take Social Security depending on my age now or wait? What pensions do I have? Am I going to have to tap my assets? What about required minimum distribution? Am I at an age where I have to start taking money out of my IRAs at ordinary income? Are there expenses that I may need to consider cutting back? There's a lot of free tools out there. AI is amazing. It can give you quick answers. It's not going to give you the in-depth human piece of making decisions because it's not always black and white. Sometimes you got to take off the financial hat and say, let's talk about the real world. In the real world, you should be able to cut X in expenses, but I can't sell my house that easily. So that's not in the real world. So what can we do? So I think that's where the human overlay comes on to the technology piece of it. But it's planning. Yeah, it's really planning. And it can be last minute planning, but it's better than no planning.
Yeah, no, I agree with that. That's one of many of our listeners were saying, hey, their real concerns are some of them have been recently been notified of a layoff. And some are like, hey, I'm looking to retire. I've got 6 weeks to go before I'm done.
Right.
What should I do? One of the things that people tend to ask about here is we're end of the year, it's the holiday season. We want to start giving. What's the best way to go about doing something like that?
Yeah.
What are the options for that?
There's a lot. So one of the most underutilized tools is QCDs. So if you are of required minimum distribution age, you can take money out of your retirement account for the required minimum distribution and give it to qualified charitable deduction. Don't quote me on the number, but you can give up to about $102,000 of your required minimum distribution directly to charity. So if someone is, and again, I'm not a CPA, I'm not playing tax advice, but if you write a check to a charity for $5,000, you don't get 100% deduction on that. If you have a required minimum distribution that you must take at ordinary income and you give that same 5,000 to the charity, you don't pay tax on $5,000 of that distribution. It is a smart way to give money to charities. That's number one. Number two is highly appreciated securities. Most charities can accept them because they get to do the sale. So that's another strategy. Some people use donor advised funds, a DAF, as you may have heard of. Very easy to set up. Fidelity, for example, has one. You can set up a DAF. You can put investments into a DAF. You can sell them without triggering gain. You get the deduction, and then you can divvy up where you want the money to go. Some more sophisticated DAFs let you put the money in, get the deduction now, and then divvy it up over time, but you can still manage the money. I had a client who had some Philip Morris stock. They didn't want the charity to know that they had Philip Morris, but they wanted to donate highly appreciated security. So we opened a DAF, put the Philip Morris in, they sold it in there, and then gave the money to the charity. The client got the deduction, the charity got the net proceeds. Donor advised funds are a great way of doing charitable deductions as well.
That's great. Hey, Brett, stick with us. Everybody's going to be right back with more Brett Bernstein here on Saving with Steve. Hey, welcome back to the Saving with Steve show, where we talk about the ins and outs of money. Pretty much everything under the sun relates to you having a happier, healthier relationship with money. And we're talking with Brett Bernstein. And you know what? We're going to be talking a little bit and answering your questions that you've been emailing into the show. The first big question was, we just saw Fed Chairman Mr. Powell lower interest rates by 25 basis points. And everybody goes, what does that mean to me? How does that affect me? Brett, I just want to pose that to you. I appreciate if you could share with our listeners and viewers what that really means to them and how it might affect them.
Yeah, most directly, your mortgage rates should come down. If you're looking to get a new mortgage, your money market rates will start to come down. Your credit card borrowing debt should start to come down. Your car loan rate should start to come down. So the things that we feel every day, that's the things that we should immediately see. Money market rates were at 4 and now they're coming down to the 3s. That's where you're going to start to see the average person is going to start to see those types of things. If you have a variable loan, a securities-based loan tied to SOFR, things tied to prime, home equity loans, the rates are all starting to come down. Fed moving rates has much more impact on money supply in the economy, but keeping it on a simplistic level, that's what the average person should start to see. Lowering rates should benefit them on borrowing, but also on their savings, but it can have other consequences, whether it's the labor market or other things that can happen. Your borrowing debt starts to come down.
So the feeling why it was done was because we're starting to see an uptick in unemployment. Is that the reason that he did that, or?
I can't speak on exactly why they did it, but I think
Okay.
the one specific thing that we've seen is, look, at the end of the day, the bulk of the data has been very healthy that's been out there, right? Unemployment has been at a historical low. Yes, numbers move around, and with the government shutdown, we're not getting data the way that we did before. But for the most part, earnings are coming in very healthy. Unemployment has been very strong. Inflation has ticked down significantly. It's not at the Fed's 2% benchmark, but it's still down well. Hiring's been decent. Layoffs haven't been too bad. Now we see, but every day we get something unique. For example, the October numbers for seasonal hiring is the lowest it's been in a long time. Last year at this time, there were 750,000 seasonal employees estimated to be hired, and this year it's under 500,000. That's not positive news. But then people get concerned about valuations and is the market too high? And we hear that. And Look, you've heard about the Magnificent Seven stocks that people have talked about. AI is what's driving a lot of things right now, and the spending going into it and what people are estimating, right? But when you remove the AI, which again, I'm not saying that it's not maybe slightly overvalued, I don't get some of the value, but when you start looking at more core businesses, okay, you look at some of the earnings that are coming out in staples, and I am in no way giving recommendations on buying these stocks. McDonald's, other names that you've all heard of, their earnings are coming out pretty good. And many companies are not drastically reducing their forecasts moving forward based on tariffs. What's the Supreme Court going to rule? They just heard oral arguments yesterday if the administration can keep the tariffs in place. That's not to say it's not going to have negative impact on the markets. But if you look at the fundamental data, it's still coming out fairly healthy. That does not mean there are not headwinds ahead in front of us, but there's still a lot of great data. The headlines are all AI, right? This company with that company. This one's investing billions of dollars. But then people forget, like all the companies that we're using every day are still pretty good. The airline industry outside of the government shutdown has been pretty positive. Travel and leisure, pretty positive. When you look at where numbers of hiring are coming, hospitality, travel and leisure, if the economy was in the toilet, people wouldn't be traveling. Those companies wouldn't be hiring. So that's not to say that there isn't negative ahead of us, but I think overall in a pretty decent place.
So now I'm going to temper that with something that one of our viewers actually wrote in. He says, you know what, I've been watching Warren Buffett. He's a Warren Buffett fan. He noticed that on average, Warren Buffett keeps about 17% of the portfolio in cash or cash equivalents that he can liquidate and go accumulate things. But over the last year or so, it's gone up to about 32 to 34%, a significant increase. What should I be looking at? Is it him getting prepared to make big purchases if things go down? Is it him getting
Mhm.
prepared for what? Why would somebody do that in a portfolio?
Yeah, it's a good point. It's no longer Warren Buffett. He
Oh, I
announces,
understand.
in all seriousness, I think it's hard for an individual investor to compare what a conglomerate like Berkshire does, right? Because they have deals that get unwound, right? They decide to take certain when they make a move, they're moving significant amounts of money. They also could be piling up either, could be for market downturn, but it could be because they're making a move for something, right? There's an acquisition they want to make. I think investors have to remember that it is normal for markets to correct between 3 and 5 times per year on average of 5%. And a one-time correction of at least 10% is normal. We had a couple fivers this year. We had over a tenner earlier this year, if not actually, I think twice. But we've been on a stretch, right? So post-liberation data now, it's been straight up. Humans have short minds when they remember these things, but it is normal. So these pullbacks and things are normal. Maybe Berkshire is stockpiling cash for something. That doesn't necessarily mean it's an indication the market's going to come back, pull
Mhm.
back. But people have to remember, if the market pulls back 5, 10% from now, the world's not coming to an end. The markets are at all-time highs. So think about it. Let's say the Dow's at, I don't know, 46, 47,000. And I said we're going to have a 10% correction. And so the Dow goes from 47 to 42. If I told you 3 or 4 years ago the Dow would be at 42,000, you'd be like, Brett, you're out of your mind. But then the thought of, oh my God, it could go down to 42,000, it's normal. And as some of the largest Wall Street executives were talking about yesterday and the day before, and saying, hey, we could see over the next 12 or 18 months a decline, they all said it's healthy. You
Mhm.
need that dip to spark the next growth. Except an average investor, and some of them said it, don't try to time the market. Have good diversity. If you are overweighted in certain asset classes, maybe reduce some of those, but don't try to time the market. Look, how many investors do we know that have been successful at turning $100,000 into hundreds of billions? One, you just brought them up, right? None of us are going to be able to compete. So let's just be smart with discipline,
Yeah.
and I think that proves the point over time.
Yeah, it's tough to compete with the goat, so I get
Yeah,
that.
yeah.
Hey, folks, stick with us. We're right back with more Brett. This is wonderful information, so don't go anywhere. Hey, welcome back to the Saving with Steve show. I want to thank you for joining us today. You know what? I truly want to thank you for sharing this with your friends and family. Again, all the replays are available at Saving with Steve. If you're enjoying stories of helpful information and insight in Saving with Steve, I encourage you to subscribe to our YouTube channel. Never miss a show. Check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York City, E360 TV, Las Vegas TV networks. All these networks are dedicated to empowering you to solve problems, uplift your spirit, and live a life of personal financial freedom. You can also follow us on Facebook at Saving with Steve Sexton on the Insiders Club. But let's get back to Brett. We have one big burning question. Probably 450 people asked this in a similar form. The cryptocurrency industry, the Bitcoin, all that kind of stuff. Is it something that people should be investing in, looking at? You know what? I don't think people understand what's going on because, quite frankly, it's just a few years old compared to everything else.
It's a tricky topic, right? The problem with investing in crypto is the average investor has no idea what it is, right? They think they do. If you ask someone, what is Bitcoin? They have no idea. What's Ethereum? They have no clue. You ask them what Doge is, it's a Department of Government Efficiency to some people, and to others, right? The reality is, up until a few years ago, you couldn't get it other than in the totally unregulated markets. Now, at least there are buckets of ETFs, right? You can buy publicly traded index funds where you get access to it. So you don't have to figure out, how do I open an account at Kraken or Gemini or one of these exchanges? You don't have to figure out, am I going to keep it on the exchange or put it in cold storage? And you can just buy an index and get exposure to it. Now, the problem is, as a wealth advisor, it is hard to say to someone, let's go invest in an investment that you have no idea what it is. Most advisors don't fully understand it. It's a gamble, right? So what I say to my clients are this: if I'm not a couple hours away from Atlantic City, right? Let's say we're going to hop in the car and drive to the Borgata Hotel and Casino in Atlantic City. And we're going to go to the casino and we're going to go to the roulette table and put all our money on one number and one color. How much would you do? I would never do that, Brett. But if you did, how much could you afford to gamble with? Whatever that number is how much they should put in crypto. For the average investor that says, I just want to have some, fine. $5,000 is what you might put on that. Then let's do $5,000 in an allocated piece. But then it comes back to people's ability to sustain risk. Risk is defined by volatility to me and loss. So sure, there are young people that have put 30, 40 grand in and it's worth $1 million in some crypto today, but it's on paper, right? I hate to use the gambling analogy, but there's a reason casinos have the biggest buildings in the world. You can have all the chips you want at the blackjack table, but until you go to that cage, you haven't cashed them in. And that's what I think the concern is. People have all this stuff on paper, but what does it mean? Do I believe in blockchain? Do I think there is validity to the concept behind different forms of crypto? Yes, I do. If I was going to do it, I would want to buy the biggest blue chips, the names you have heard of for the longest amount of time. I'd want to do it in the most public way, unless I had some knowledge or I was connected with an expert in it. I do think crypto is here to stay. I don't believe it's replacing fiat money. I just believe it's becoming an asset class that you can't ignore. Just like gold. Gold has hit all-time highs, but I wouldn't put more than a certain amount in gold. Now, yes, we know gold is a commodity, right? But there's only so much you would put in gold. There's only so much you would put in silver. There's only so much you should put in crypto. And remember, it's not regulated like other investments are at the current time. So people have to take that into consideration.
That's wonderful. I appreciate that. I was reading something that only 4% of the world uses crypto. And I thought to myself, wow, there's a long way to go if you want the rest of the world to use it. So it could be something that moves in the future, but at its infancy, it could be very scary. It's almost like the beginning of the internet.
Agreed, but that's why they've come out with things like stable coins and others. You can't say I'm going to buy a car with Bitcoin, right? When the price of Bitcoin can move 8-10% in minutes. But if you can tie that to a stable coin where you have the ability to pay with it, that's important. The other problem is, because of the lack of regulation, concerns that people have is what corrupt business is potentially tied to it. And so you have to be careful. That's the same thing where they have to figure out how to get their arms around it. But doesn't it go against the ethos of what blockchain and crypto is? It's not meant to be regulated like that. So you're taking regulated industries with an unregulated asset class and trying to marry them together.
That's wonderful. I appreciate you sharing that so everybody has a better idea of what they should be looking at, how they should be looking at if they're looking to get into crypto. Brett, hey, there's a lot of people that be listening to you today and say, you know what, I'd like to have a chat with Brett or Brett's team. So how do people get a hold of Brett at XML Financial?
Yeah, no, thank you. You appreciate you having me. I love having these conversations. The easiest way to find us is on the internet, xmlfg.com. That's xmlfg.com. You can read all about us, see all the pieces that we put out there. You can connect with our team if someone speaks to you about their background or whoever they are. We work with clients all over the country in different parts of the world, and we're always happy to talk to people.
That's beautiful. So, folks, that's xmlfg.com. So, you probably want to check that out. Hey, Brett, I want to thank you so much for being with us today. This has been wonderful. And you know what? If you're open to it, I'd love to have you back sometime in the future to talk about other things.
I appreciate you having me.
Appreciate you being here.